Welcome to Keys Open Doors. Today, we're breaking down how today's daily interest rates impact your path to buying a home.
Okay, let's dive right into this. If you open up any financial news page on any given day, you know you're instantly bombarded with a massive wall of percentages. You've got overnight rates, one-month rates, 30-year rates, index rates. Honestly, it's a total alphabet soup of numbers. And if you're an aspiring homebuyer, that can be incredibly overwhelming. You're probably asking yourself, which one of these dozens of daily market numbers actually dictates the cost of my future home loan? Does a rate hike in one random area automatically mean your mortgage just got way more expensive? Well, it's a great question, and today we're going to cut through all that noise.
Here's our roadmap for today's explainer. First, decoding daily rates. Second, the mortgage benchmark. Third, the prime rate. Fourth, inflation trends. And finally, protecting your buying power.
Let's jump right into Section 1, decoding daily rates, or what I like to call the economic weather.
For today's explainer, we're using a specific real-world snapshot from May 26, 2026. The 3.62% figure we're looking at is what's known as the effective funds rate. Think of this as the absolute baseline temperature for our economic weather. In the simplest terms possible, 3.62% is the median everyday rate at which major banks borrow money from each other overnight. It is literally the absolute ground floor of borrowing costs in the United States economy.
So the absolutely crucial point here is that while you, the everyday home buyer, will never just walk into a bank and get a 3.62% mortgage based on this specific overnight rate, this number still matters immensely. Why? Well, because banks are businesses. If it costs them 3.62% to borrow the money that keeps their lights on and their vaults full, they're going to pass those foundational costs directly onto you when they lend you money for a house, a car, or a credit card. It basically sets the floor for everything else we're about to talk about.
Moving on to Section 2, the mortgage benchmark and finding the magic number.
If the overnight rate is the broad economic weather, we now want to find the specific, localized forecast for your 30-year fixed-rate mortgage. And to find that magic number, we kind of have to bust a little bit of financial jargon. You're often going to hear the term constant maturities thrown around in market data. Now, I know that sounds incredibly intimidating, but it just means this. It's a standardized, calculated way to compare the cost of borrowing across completely different lifespans. It allows us to accurately compare what it costs to borrow money for exactly 1 month versus 1 year versus 10 years, even if there isn't a single specific bond trading out there with that exact expiration date. It normalizes the data so we can see the real trends.
And that brings us to the real star of the show, 4.56% on our May 26 snapshot. This is the 10-year nominal constant maturity rate. If you're an aspiring homeowner, this is absolutely the single most critical benchmark you need to watch. Forget those overnight bank rates we talked about a minute ago. This 10-year rate is the anchor point that the entire mortgage industry uses to price long-term home loans.
Now, let's be crystal clear about this. You are not going to get a 30-year mortgage at exactly 4.56% in this market scenario. Lenders have to add their margin, their profit, their risk calculation, their operating costs, right on top of that benchmark. So your actual quoted mortgage rate will for sure be higher than 4.56%. But, and here's the key, when this 10-year benchmark goes up, mortgage rates go up. When this benchmark goes down, mortgage rates go down. They move in lockstep. If you want to know which way the wind is blowing for your future home loan, keep your eyes glued to this 10-year rate.
All right, let's pivot to Section 3, the prime rate, covering credit cards and HELOCs.
We really need to shift focus for a second, because your readiness to buy a home isn't just about the mortgage, right? It's about your overall debt load. Think about the 6.75% mark. This is the bank prime loan rate. It's the base rate posted by the vast majority of the top commercial banks in the country. If you have excellent credit and you take out a short-term business loan, or, far more commonly, if you're looking at your credit card interest rates or a home equity line of credit, a HELOC, this is the foundational number those products are built on. This brilliantly illustrates the divided nature of your financial life as a buyer. You've got that 4.56% 10-year benchmark driving your long-term fixed mortgage costs. But meanwhile, you have the 6.75% prime rate dictating your short-term variable consumer debt. If that prime rate is high, the cost of carrying balances on your credit cards is high, which directly eats into the monthly cash flow you desperately need to save for a down payment or to qualify for a mortgage.
Next up is Section 4, inflation trends, where we start visualizing the curve.
So how do all these different rates actually connect, and what do they tell us about the future? Well, by mapping out a nominal yield curve, we can understand how the cost of borrowing increases as the lifespan of the loan stretches out. To borrow money for 1 year, the rate is 3.86%. To stretch that to 10 years, it rises to 4.56%, and for 30 years, it peaks at 5.07%. This upward slope is generally what a healthy market looks like. It shows us that lenders demand a higher return for locking their money away for a longer period of time, primarily because they're taking on the long-term risk of inflation, just eating away at the value of their money.
This builds a genuinely fascinating picture of inflation expectations. We have our standard 10-year nominal rate at 4.56%, but then we have the 10-year inflation-indexed rate sitting way down at 2.16%. So what does that mean for you? It means if you technically strip away the market's expectation of future inflation, the real, fundamental underlying cost of borrow money for 10 years is only 2.16%. The gap between those two numbers, which is roughly 2.4%, is exactly how much inflation the market is baking into long-term loans.
And finally, Section 5, protecting buying power and navigating the market.
So, we've decoded all the numbers. Now let's talk about what actually matters to you. While a lot of buyers stress out over daily rate fluctuations, general education tells us the absolute best defense is a strong personal financial offense. First things first, boost that credit score. It ensures you get the best possible margin above that 10-year benchmark. Second, heavily reduce your prime rate debt. Pay down those 6.75% plus credit cards to free up your monthly cash flow. Third, aim to save a larger down payment to insulate yourself against higher borrowing costs. And finally, always remember this is just general education. You should absolutely consult a licensed mortgage or financial professional to look at your highly specific, unique scenario.
I want to leave you with a provocative thought as we wrap up today's explainer. The economic weather, it's always going to change. The 10-year benchmark will fluctuate. The prime rate will go up and down. But the real question is, are you letting daily market rates dictate your home buying timeline? Or are you focusing on your own financial readiness? Empower yourself by focusing on what you actually can control, your credit, your savings, your debt, so that when you are personally ready to buy, you can weather whatever rate environment the market happens to hand you.
Keys open doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.